Hello, I'm MaryAnn, and I'm here today with Satish Rai, who is Chief Investment Officer at TD Asset Management. And we're talking about what he's expecting for 2014. Now, Satish, you were telling me that it seems a lot like deja vu this year. What do you mean?
Well, the biggest influences to financial markets last year was a tremendous amount of stimulus that governments gave financial markets in the form of printing of money. That's U.S. government, European, and also Japan, who's joined the fray. At the same time, they also kept rates very low. So our thought process is that for 2014, we're going to continue to see a very accommodating policy by central banks around the world. We're going to continue to see the U.S. government print money at a slower rate, but they're still going to print money. We still expect Europe to be very accommodating because they still have structural issues. And we still expect Japan to print money. And at the same time, we do not expect Canada or the U.S. to raise rates for the balance of this year. So 2014, as influenced by central banks, remains exactly the same as was last year.
Now, with the tapering that we're hearing about and it's in effect, what are you expecting? What exactly happens with that?
Well, I think we have to remember, first of all, there's $4 billion of debt that is now held by the central bank in the U.S., and they're actually going to keep increasing that amount at a slow rate. So the amount of money held by central banks is going to grow. So tapering doesn't mean they're removing liquidity. It just means they're not adding it as quickly as they were in the previous years. The second thing is that we don't expect them to unwind this balance sheet they have anytime soon. So the tapering we do expect to happen in the U.S. this year, but I don't think it'll be as bad for financial markets as most people are making it out to be. Remember, the balance sheet's still going to stay, and it's only when we start to see a tightening of monetary policy would we get concerned for financial assets.
So how does that relate then to the investor looking to invest? Where would you recommend?
Well, I think, last year we had two things happening. We had PE ratios rise, and we also had earnings grow. So this year we're expecting earnings to grow again in the U.S. and Canada, and we continue to think that PE ratios could go up a little bit more. And the reason is this: the PE ratios on the S&P 500 is roughly 15 times. Our view is that's the average of the last 30 years. But the last 30 years we had much higher interest rates. So our view is that with interest rates being so low, the market can actually have a little higher PE ratio. So our view is earnings are going to grow, which is going to drive financial markets. At the same time, we still expect a modest PE expansion, which will also add additional capital returns.
So what kind of growth are you expecting? How fast?
Well, I think it'll surprise people in the U.S. How good the growth is. Growth has been struggling to be around 2% in Canada and the U.S. for the last couple of years. And our view is that the U.S. growth will be closer to 3% and maybe even higher because we're seeing very strong numbers in housing, we're seeing very strong numbers in autos, and we're also seeing better general manufacturing job growth. It's 2 steps forward, 1 step back, but on average we expect slightly better growth. And in Canada, we also expect slightly better growth also because the Canadian dollar has fallen. And while it makes us feel poor when we're importing goods, it's probably a net benefit to Canada because we are an export nation. And as the Canadian dollar goes down, it makes our manufacturing sector much more competitive.
So are there any specific sectors that you would invest in right now?
Yeah, so I think that there's 2 things. First of all, our focus has to be on investing in real businesses with real franchises, real earnings. And we continue to find that that's available in big cap and small cap spaces. So I would encourage people to look at the highest quality investments, the companies that pay dividends, that grow market share during times of troubles. Now, we also believe that the drag that took place from the commodity space in Canada, so last year, 2013, the commodity space in Canada dragged down the TSX versus the rest of the markets.
Gold down 28%.
Gold was down, and copper and many other commodities were down. And so our view is that drag for 2014 will not be there, and we might actually get an uplift by the end of the year. So that relative underperformance that Canada had against the U.S., that big underperformance, is unlikely to take place for the next 12 months.
So that's good then if that reverts back to, would you say, the mean?
Well, I think the good quality big companies in Canada in the commodity space are going to do very well. I think the small, really small companies that are in the early stages are going to continue to have troubles getting financing. So I think in the commodity space, you really have to separate the big cap ones with strong balance sheets that can grow, whereas the small ones that might have a good project, but they don't have the balance sheet to actually take it forward.
So really doing your homework.
I think 2014 will be much more stock specific than the past couple of years where most markets went up. You have to be much more selective this year.
Now, what about fixed income?
Yeah, so our view is that interest rates in the U.S. and Canada, as administered by the central banks, by the Federal Reserve or our Bank Canada, they're not going to change for this whole year. So U.S. interest rates are close to zero. Our rates are about 1%. It's unlikely that the Federal Reserve would raise rates, and it's unlikely that Canada would raise rates until the U.S. Raise rates. So I think it's important to understand the short-term rates are anchored at a very low level. And the long-term rates have backed up somewhat, 50 basis points to 100 basis points. And you can only back up so much because you're anchored by the short end. The other thing that we're seeing is we continue to see an environment where inflation is very tame. Both in Canada and U.S., inflation is below the Bank of Canada's target. And that implies that there's no real reason to raise rates if inflation is below your target. So I think what will happen is the 5, 10, and 20-year rates will trade in a trading range, about 50 basis points, but the short-term rates will be anchored right where they are today.
All right, so what would you say to bond investors then? Hold for the long term?
So I think for fixed income investors, two messages. First of all, you have to reset your expectations of fixed income. We've had this tremendous tailwind over the last 10, 20 years where fixed income is giving you income and capital gains. So our view is you're only going to get income today, you're not going to get capital gains, and that started to play out last year. The second thing is we continue to like corporate bonds. They do provide incremental yield, and we also like some high yield bonds. So you can actually pick up 4, 5, 6% in some of those corporate bonds. But understand that ultimately the capital gains that we've experienced for the last 10 years in fixed income are behind us. So if you need a higher rate of return, I think you have to look to high quality equities for your alpha generation and look to your fixed income as your stability portion of your portfolio.
Now, last question. Would you go outside of North America into emerging markets at all?
So, our view is that Canada has underperformed quite a bit over the last couple of years, and we're going to get a much more balanced environment. We continue to like Canada, we like the US, we like even Europe because there's so much money coming out there. We also like Japan. The emerging markets are probably going to be the last stage to go up. So we need the US, Europe to go up first, and then you'll see the emerging markets. But whatever you do, it's imperative to have the highest quality investments, especially when you're in emerging markets, because there's multiple risks associated with emerging markets. There's the country risk, there's a currency risk, and the US you have the company risk. So I encourage people that if they do go abroad, to make sure they have the highest quality investments.
All right, thank you very much, Satish.
Thank you so much.
I've been joined by Satish Rai, who is Chief Investment Officer at TD Asset Management. Thanks for watching. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.